Today is April 12th, 2026, and if you are a senior in America, there is something happening with your bank account right now that you absolutely need to understand before you make your next cash transaction. This is not a scare tactic. This is real federal law, and it has been in effect longer than most people realize. But in 2026, the enforcement and monitoring systems behind this law have become more powerful than ever before. Stay until the end, because what you learn today could save you from a federal investigation, asset seizure, or a legal nightmare that starts with something as innocent as making a few bank deposits. Welcome to U.S. Immigration Intel. Let's get straight to it. The rule is called the Bank Secrecy Act. It has been federal law since 1970 and was strengthened by the Patriot Act in 2002. Under this law, every bank and credit union in the United States is legally required to report any cash transaction of $10,000 or more to the federal government. This report goes to the Financial Crimes Enforcement Network, known as FinCEN, which is a division of the U.S. Treasury. And yes, the IRS has access to this information. This is not new. But what is new in 2026 is how the monitoring works, how thoroughly banks are now scanning your transaction history, and the serious consequences that can follow if you handle your money the wrong way without even realizing it. Here is the part that surprises almost everyone. Under the Bank Secrecy Act, banks are legally required to report any cash transaction exceeding $10,000 to the federal government. This is a standardized process to help the Financial Crimes Enforcement Network track the flow of physical currency and help prevent money laundering and fraud. But here is what most seniors do not know. The report being filed does not mean you are accused of anything. The creation of a currency transaction report does not mean that your account will be frozen or that federal agents will be visiting your home. For banks, it is considered standard procedure and is not a cause for concern if the deposit is legitimate. So if you have sold a car, received a large gift, or withdrawn retirement savings to handle a major expense, and that amount is over $10,000, your bank will report it automatically. You do not need to do anything special. You simply need to be honest and have a clear, legitimate reason for the funds if anyone ever asks. Now here is where things get genuinely dangerous, especially for seniors. And this is the part of the video that you must pay very close attention to. Many older Americans trying to be careful or simply not aware of the law decide to break up a large cash amount into several smaller deposits to avoid hitting that $10,000 mark. They think they are being smart or cautious. They think they are just keeping things simple. But what they are actually doing is committing a federal crime called structuring. Structuring, sometimes called smurfing, means intentionally breaking up large cash amounts into smaller deposits to avoid the $10,000 reporting threshold. This is illegal, regardless of whether your funds come from legitimate sources or you have paid all your taxes. Common examples that will get you in legal trouble include making 3 consecutive deposits of $5,000, $3,000, and $2,000 instead of one $10,000 deposit, depositing just under $10,000 multiple times over several days, or distributing deposits across different banks to keep each one under the limit. Let that sink in for a moment. You could have completely legal, fully taxed money in your hands. You could be a retired senior who has done everything right your entire life, and if you split that money into smaller deposits with the intent to stay under the $10,000 threshold, you are committing a federal crime. The government can seize your money even if it was earned legally. If you have $12,000 and decide to make 3 separate deposits of $4,000 to stay under the radar, you are committing a federal crime. Banks use AI-driven monitoring to flag patterns of deposits that fall just below the limit. These systems have become significantly more sophisticated in 2026. This is the part that has genuinely changed in 2026. The technology is not the same as it was 5 years ago. Banks are now using advanced systems that can link your transaction patterns across different branches and even across different banks instantly. If you deposit $9,000 at one bank and then $5,000 at another bank the same week, the system can connect those two transactions and flag them as a potential structuring attempt. The IRS regulation specifically reads, "Structuring is illegal, regardless of whether the funds are derived from legal or illegal activity." The law specifically prohibits conducting a currency transaction with a financial institution in a way to circumvent the currency transaction reporting requirements. And here is what an experienced tax professional said about this. Structuring will get you in hotter water than simply depositing $30,000 openly and honestly. So, what should you actually do if you have a large amount of cash? The answer is simple. Deposit it honestly and let your bank file whatever report they are required to file. A currency transaction report is not an accusation. It is paperwork. It tells the government that money moved. As long as your money is legitimate, you have nothing to fear from the report itself. The danger only comes when you try to hide it. Now let us talk about the other major development that every senior needs to know about for 2026. The IRS has introduced a significant new tax benefit specifically for older Americans this year that most people are not taking advantage of. For tax years 2025 through 2028, taxpayers who are age 65 or older may be eligible to claim an additional $6,000 deduction per person or $12,000 if married filing jointly, and both spouses are eligible. To be eligible, the person must be 65 on or before the last day of the tax year. It is available to eligible taxpayers who claim the standard deduction or itemize. This deduction phases out for seniors with higher incomes. The deduction phases out for taxpayers with modified adjusted gross income over $75,000 or $150,000 for joint filers. This is real money that many seniors are leaving on the table simply because they do not know it exists. If you are 65 or older, you need to check whether you qualify for this new deduction when you file your 2025 taxes. This is part of the One Big Beautiful Bill Act that became law, and it stacks on top of the existing additional standard deduction that seniors already receive. The new $6,000 senior deduction can meaningfully reduce taxable income, and it applies to anyone who is 65 or older by the end of the tax year. It stacks on top of the existing additional standard deduction seniors already receive. So let us bring everything together clearly so you walk away from this video with complete clarity on what you need to do. First, understand the $10,000 rule. Any cash transaction of $10,000 or more will automatically be reported by your bank to the federal government. This is not a punishment. It is standard procedure under the Bank Secrecy Act. If your money is legitimate, this report does not hurt you. Second, never structure your deposits. Do not break up large amounts of cash into smaller deposits to stay under $10,000. Even if your money is completely legal and fully taxed, structuring is a federal crime. The consequences can include asset seizure and criminal charges. If you have a large sum of money to deposit, just deposit it all at once and let the bank handle the reporting. Third, be prepared to explain large cash amounts if asked. Keep documentation of where large sums of money came from. A bill of sale from a car, a statement from a retirement account, a letter from an insurance company. These documents protect you if anyone ever questions the origin of your funds. Fourth, if you are 65 or older, check your eligibility for the new $6,000 senior deduction this tax season. This is a real benefit created by new legislation that applies to tax years 2025 through 2028. If your income is below $75,000 or $150,000 for couples, you likely qualify. Fifth, be aware that in 2026, the monitoring systems used by banks are more advanced than ever. AI-driven tools can now detect patterns across multiple accounts and multiple banks. The era of flying under the radar with small, repeated deposits is over. Transparency is not just the honest approach, it is the only safe approach. Sixth, if you are ever uncertain about a large transaction, talk to your bank teller directly before making the deposit. Ask them what forms will be filed. There is no shame in asking. Being informed and cooperative with your bank is always the right move. At U.S. Immigration Intel, we are committed to giving you accurate, up-to-date information that actually matters for your daily life and your financial security. Whether you are a senior, a green card holder, a new citizen, or someone navigating the American financial system, knowing these rules protects you and your family. If this video helped you, please share it right now with a family member or friend who is over 65. You could be saving them from a very serious and very avoidable mistake. Like this video, subscribe to the channel, and hit the bell so you never miss an important update. We will see you in the next video.